Okay, so we've completed now. We've taken a look at the income statement. We've taken a look at the balance sheet. We built a report card. We've looked at the trends. We've dropped in some comparative data. We've got a score sheet at this point. Question for you. Now the fun begins. First of all, that's not a question. I recognize that. What percentage of businesses out there do you suppose ever get this far? What percentage of businesses out there do you ever suppose ever build a score sheet like this? 5 to 10%. I've had people say as high as 20, but that's still 80 that don't. I've often wondered if there's a correlation between the 80% that don't and the 80% that fail. I don't know that, but I gotta believe if we could get every business owner who runs a business to use a score sheet like this, we could get better performance. And I suspect the success rate would improve. I do know that if you were my customer, you would do this. Why again? Because I would make you do this. That's what my banker did for me. And it was a huge, huge positive for me. It just created an attitude, a way of looking at information that was very different and very useful. And once I got involved and used it, it's not that hard, is it? There's nothing here that's rocket science. There really isn't. What we do need, though, is we need now some kind of a picture to identify and spot the leaks, if you will. There are plenty of leaks here. And we talked about spotting the leaks earlier, and the role of management is to spot the leaks and what? Plug them. And so I built a tool that turned out to be really helpful as a communication tool. I called it the roadmap. I've got it up here. You can take a look at it. You have one as well. Now, I've got a little bit of a visually different one than you do for a couple of reasons. What I did was I started talking about thinking about how does money flow through a business. And I started wanting to make the connections between cause and effect and actually track how money flows through a business. And it's like anything else you start. You start with an idea and it gets bigger and bigger and bigger, and you keep adding to it. So I started with this, and I thought maybe I can do this so that none of the arrows cross any of the others. You with me on this? So I could just create a diagram, a flow chart, of how money flows through a business. And I worked on this for 8 years. Not all the time. Just when it struck me, you know, because when you start with something like this in a clean slate, you have these moments where it just goes, okay, I can see that and I can see that, and eventually it got built. And what I've done is each of those boxes in my roadmap really constitutes some kind of a management decision that may or may not be controllable. Isn't that right? That's what I'm trying to do here. And I identified 3 key symptoms. What are they? It's kind of a visual thing, so go with it. Low or declining cash, low or declining margin, and low or declining profits. And then just to give you a flavor of how to read this thing, you see there are arrows on your roadmap pointing in a direction. So what I'd like to do is take a trip through the roadmap so then you can use it as well, okay? This is the user's manual for your roadmap. Starting at low, and when I say, by the way, low, I said low or declining cash, meaning what? You don't have to be bad to be getting bad. Catch a problem when? Early detection, clearly used in the medical field, works just as well in the financial field, doesn't it? Early detection is the key to successful treatment. Low or declining. All right, now, starting at the low cash box, going out the left-hand side and going straight south. In the direction of the arrow, between the 2 boxes, you put in the word causes. Causes. Low cash, causes. What's the first one you come to? Track with me. Low cash, causes. No cash discounts on payables. Correct, meaning you effectively pay more. No cash discounts on payables causes low gross margin. Low gross margin causes low net profit. So far, this looks like a gravity system, doesn't it? It's a complete circulatory system. I call this process sometimes the fiscal physical, taking a trip through the business, okay? Giving the business a what? My medical analogy. A checkup. You all get a checkup once a year, right? Once every 2 years? Once this decade. Close enough. But a regular checkup. Clearly doable. All right. Now, my medical analogy also looks like if I went in for a physical, they'd take an X-ray, wouldn't they? They take the X-ray, they shoot it up on a screen, or these days on a computer screen, and what are they looking for? When you got an X-ray and you're a doctor, what do you... Gray blobs, usually. Isn't that right? Something that's an abnormality. And how do they know it's an abnormality? Because they've seen lots of normal ones. Isn't that right? And what we're going to do is we're going to try to spot the abnormalities. How will we know the normal ones? On our scorecard, we've got what? An industry composite of normal ones. Isn't that right? So we've got a yardstick of comparison as well. Okay, keep going around. And this is a complete circulatory system. I mean, when they put it up on a screen, this is the same as we've done, except they're looking, when the doctor does it, they're looking at a skeleton of you. Now we're looking at a skeleton of what? Your business. But we're looking for the same things, the same kind of issues. It's a health issue here, folks. All right. And it's complete circulatory system as well. Low net profits causes, in the direction of the arrow, what? Low retained earnings. We talked about retained earnings. If there's no retained earnings, we go, nothing. Remember that? And if there's low retained earnings causes, if we're trying to grow and we need more assets and we're not doing it with money that's kept in the business, we're going to do it with what? Borrowed money. High liabilities, which causes high borrowing. You with me on that? Okay, now, let's go the other way. Drop down to low net profits and go against the arrow. All right, let's go against the arrow. Go upstream, if you will. And when you do that, put in the phrase, is caused by. So low net profits is caused by what? You go up one level. You go up one level. Low net profits is caused by what? High interest. It could also be caused by, in fact, we'll talk about sales and costs in our next section, section 3. High hidden cost. It could also be caused by poor expense control. You with me on this? And I've put all of the causes of a low net profit on what? One line. It could be one of them, or it could be all of them. When we're trying to look at a business, we don't want to just do a knee-jerk kind of, oh, it's got to be that. Could be that. Let's take a look at the whole thing. When you go in for a physical, they don't just do one test, do they? They do a bunch of tests because they're trying to get a picture of the whole person. We're trying to get a picture of the whole company. Likewise, low gross margin going upstream is caused by what? No cash discounts on payables. Right next door, it could be caused by? Also caused by? And? Shrinkage. What is shrinkage? Theft. Who steals? Employees? And everybody steals. What will they steal? Everything. Gosh, here's a thought. You're here and there. Well, anyway. Low gross margin could be caused by bookkeeping errors. It could be caused by poor buying. Paying what? Too much. Poor pricing. Selling it for what? 504. Or some, but nobody would do that, of course. Low cash. One more item up there. Low cash. One more symptom. Low cash going against the arrow is caused by too much inventory and or too much what?
Customer credit.
Too much credit. Exactly. You with me? And it could also be caused by high current liabilities, typically a bank situation. Now what we're trying to do is we're trying to spot what? The leaks. We're trying to spot the gray blobs. We're trying to spot the leaks. And the role of management will be to plug them. Isn't that right? Sending more money down to profits and more money up to cash. P or what? Profits, P, cash, C, right? P or C. With me so far? Mm-hmm. Not a tough picture to understand. Now what we need to do is merge what? The roadmap with your scorecard. Isn't that right? So let's try that. Low cash. What two ratios on your scorecard would measure the ability to generate cash? There's one in particular, but two in general. What numbers?
1 and 2.
What number are they?
1 and 2.
1 and 2. Absolutely. Which ratio number measures gross margin? What number?
4.
Number 4. And which measures net profit or net margin?
5.
Number 5. So let me ask you a question. Reviewing your scorecard, ratios 1 and 2, does he have low or declining cash?
Yes.
No, he has low and declining cash. He's low and getting worse, isn't he? Number 4, does he have lower declining margin? Absolutely. It's going south. And lower declining profit? Yes. He's 3 for 3, isn't he? He's got all of the symptoms, as it were. And these, in fact, are the symptoms, are they not? What we want to get back to is the what? The cause. What caused it, isn't that right? Now, where shall we start? We potentially now have what folks have termed the paralysis of the analysis. I don't exactly know where to start. It's like a whole lot of stuff. Where would you start? Any thoughts?
Pick one.
Pick one. Pick one is actually workable, isn't it? In the sense, well, first of all of his ratios are going the wrong way. If he had a bunch of ratios that were going the right way and only a couple going the wrong way, wouldn't that clue us right into where to start? Yes. But that doesn't help us here because they're all going the wrong way. Another way to think of this, if you happen to have an engineering mind, this is really what? It's a flow chart, isn't it? And it's a closed system. So technically, you can start where? Just like you said, anywhere. Because it will eventually take you what? Everywhere. Or you can do what I do. I have a bias about where I start, and it's really a simple one. I start where the profit and cash cycle tends to overlap one another, and it's right here. Gross margin. And what I've learned is if you can't make a gross margin commensurate with the industry long term, where are you? Sucking wind, as someone said earlier. So let's just take and do a little comparison here and use the numbers. Let's use the numbers. What's his gross margin? 18.5. What's the median for the brothers or the sisters? His comparative, his industry composite. 22.2. How much is he out of round? 3.7% of?
Sales.
What's the bottom in the formula? Sales. 3.7% of sales. And tell me again, what are sales? You've got everything laid out there. So what are the sales? 2,160,000. Now, would you be okay if we rounded the 3.7 to 4 and the 2,160,000 to make it 2? So 4% of 2 million is going to translate into how much in dollars? $80,000. $80,000 that appears to be leaking out of this company. $80,000.
At least.
Is that a lot?
Yeah.
When you're making $6,300 before tax, that's a lot. And all I'm thinking is I'd like to see him be at least as good as who? The median. And all the excuses. There are no, in my view, there's no excuses. There's only a lack of performance here. So what's the message? It's time to perform. It's time to roll up your sleeves and figure out where the problems are. Isn't that right? So what we need to do is we need to take a look on our screen and or on our roadmap and see what are the possible causes of a low gross margin? Somebody help me out. What are they? If we just take going up from gross margin, low gross margin could be caused by no cash discounts. It could also be caused by, we did this once, but let's do it one more time because we want to highlight these pieces. We're going to try to figure out in there, where is that 80,000? How are we going to find it? Could also be caused by low, yes, poor inventory control, shrinkage, which is either theft or in a manufacturing world, it could be waste, couldn't it? We're throwing away a bunch of stuff because we're not doing it efficiently. And that's, of course, the word that drives this, is we're looking for efficiency. Bookkeeping errors. It must be what? Computer error, of course. We always blame the computer. Typically, it's not the computer that makes errors. It's people who make errors, isn't it? Poor buying. Paying what? Too much. And poor pricing. Not charging enough. Is it most common in the surveys that I've seen that talk about businesses and pricing? Is it most common for businesses to overprice or underprice their product or service? Almost always under. Why?
Trying to be competitive where they think they need to be.
We think we need to be competitive. So it's what? What's the driver here? I would say fear is one of them, isn't it? Bagak. We're just flat chicken. It's really hard to raise your prices, isn't it? Oh, God, what are they going to do? No. It's hard. It's not an easy thing. And then you do it, and what happens? Not much. So what does that mean? Or you wait 5 years and then raise your prices. Instead of raising it 2 or 3% a year, you wait 5 years and raise it 15%. Then they what? Then they notice. Then you get a big pushback. Wouldn't it be easier to just do this on a regular basis? Do other things go up on a regular basis in our lives? Yes. Yeah, just stop on the way home and buy gas, right? Doesn't matter what it is, everything goes up in our life. So let's take a trip through here and just talk about where could this 80,000 be. In your business, you'd know more about this than his business, but we'll take a hypothetical example here of our company, and let's just take a trip through this. Number one, no cash discounts on payables. Now, what I'd like you to do, right in the area of the no cash discounts on payables, what's he buying? Inventory, right? He's buying supplies because he's a manufacturer. But since he's a manufacturer, and what are his cost of goods? Somebody help me with his cost of goods number. $1,760,000. That cost of goods in a manufacturer is going to be a combination of direct materials and what? Labor. Direct labor. Let's just assume that the labor is $760,000 for purposes of discussion and keeping it so we can all track. Would he know this in his business? What part is material and what part is labor?
Yes.
You'd hope so. If he doesn't know that, then he's got a huger problem than we think. Although it's not impossible that he wouldn't know that, is it? And therein lies the problem. You got to have good numbers. If you don't have good numbers, what do you got? Nothing. Bad numbers, thank you. There are two choices in life when it comes to numbers. That's exactly right. So he's buying roughly, if 760 of his cost is labor, he's buying $1 million a year of raw material, isn't he? And let's just assume that his suppliers offer him a 2% discount, but he's only able to take half of those discounts. Right now we know he's got a cash flow problem anyway, so let's just say he took half of them. That would be effectively a 1% discount. What would that bring him in additional money? $10,000. So right by the box called no cash discounts on payables, what I'd like you to do, right above it, is just write in 10,000. Taking more discounts. And I'll talk about that in just a second. And we got to label this. We got to give it a P or a C. Is this predominantly a profit impact on this roadmap or a cash impact? I heard cash and I heard profit. We got a 50-50 shot here, and I'll give you the way to figure it. Where does discounts taken show up? Which financial statement? Profit and loss, the income statement or the balance sheet? The income statement. It's an action. Your cost of goods will be changed. That's on your income statement. If it's an income, if the item we're looking at is measured on the income statement, the impact is predominantly what? Profit. So if it shows up on the income statement, it's predominantly a profit impact. It doesn't mean it can't have a cash implication ultimately, but we're trying to get primary impact. So just write a $10,000 above your no cash discounts, and in brackets put a P. All right. Low productivity. Can we measure productivity in a business?
Yes.
Lots of ways in lots of businesses. Ready mix concrete. Yards per driver per hour. Cubic yards, mind you. Pharmacy. Prescriptions per pharmacist per day, hour, pick a time frame. Accounting, billable hours, some kind of a productivity measure. Can we reward people based on productivity? Sure. Let's make an assumption that he could do an assessment of his labor. Now, I'm not certain. Is it conceivable that the owner might not spend a lot of time out on the floor of the plant? I'd say that's conceivable. And is it conceivable that the production process might not be organized in the best? I mean, it would be easy to say, well, maybe they're just lazy. Well, maybe they are. That's one possibility. What's the other? It's set up so that they can't produce at as high a level. And who was it set up by? Usually management. Who's usually doing the work? The laborers. It might be a good idea to what? Ask them if you want to know how it could be done better. But a lot of times that doesn't happen. Let's just presume that we could improve productivity by 4%. And our labor cost is how much right now? 760,000. So what would 4% of 760,000 be? Roughly $30,000. Where's that going to go? Right above low productivity, and in brackets at the end, P. You with me so far? Let's go over to the other side. We'll assume right now that people aren't stealing, okay? That might be a strong assumption, but at this point, I'm not going to assume it's a theft problem. Poor buying. Poor buying. How much is he buying per year? $1 million. If he could improve his buying, not just through the discount structure, we've already talked about that. That's the financial way of buying better, isn't it? Paying sooner. If he could just get a better what? Price. What's the best way to get a better price?
Volume. Ask for it.
Ask. Volume clearly is an option as well. Sometimes, though, you simply go and do what? Ask for a better price. Sometimes we get too locked into one supplier. We never do what? Shop a little bit. Even if we weren't intending to buy, it keeps people honest. And asking for a better price is not something we're accustomed to. At least it's a part of negotiating, and we don't typically do that, do we? That's not something we spend a lot of time doing in terms of pricing. We negotiate every day on a whole lot of things. Is getting a better price, and just 2% better, on what? $1 million in purchases. How much would that be? We've got some nice, easy, round numbers here. How much would that be? 2% of $1 million is what? $20,000 that he gets instead of whom? The supplier. Up above the poor buying, brackets afterwards what? P. Brackets afterwards P. Is this doable? I don't know yet, but I know that if he doesn't try it, they will not come back and say, we've decided to give it to you 2% cheaper, right? Or maybe even they raise the price and he says, no, I'd like to keep the same price for another year. That's the same as getting it cheaper, isn't it? Because he's going to sell it at what? A price that's based on his new cost. Isn't that right? And the final one over on the far right. Poor what? Pricing. Selling it for, paying too much is poor buying. Selling it for too little is poor pricing. And what are his sales again? 2 million, roughly 2 million. Suppose he could just raise his price what? 1% across the board. Is that, in fact, how much does inflation go up every year right now? Ballpark. 3, 4%? Well, if he's not raising it 3 or 4%, what do we know? He's falling behind, isn't he? But let's just assume for the time being 1%. If he could raise his price 1%, what would that do?
20,000.
Sorry? $22,000, roughly. $2,160,000, I just rounded it off, 1%, $22,000. Above the pricing, P or C?
P.
P. If we summarize, what have we got?
What about inventory control? Skip that.
I didn't talk about inventory yet because I'm going to come back to that. It does have a profit impact, and we'll talk about that when we get into the inventory part of the roadmap. Is that okay? I haven't forgotten it because it can have a very large impact, but it's an impact on two sides of the financial statements. All right, so what do we got now? If we add them all up, what have we got? 80,000. There's the 80,000, isn't it, roughly? If we have a little rounding error there. $80,000. So let's summarize now. We talked about gross profit margin, and that was $80,000 that he was leaving on the table, roughly 80. And by the way, did the 80 have a P or a C? P. If all the rest of them do the causes, then the symptom got to have a P as well, doesn't it? And then we said $10,000 for discounts, $30,000 for, $20,000 for buying, and 22 for pricing. We summarize all of those, And what have we got? $82,000 of profit apparently being left on the table. Now, maybe it's not in those items. I made some assumptions here because of what I knew about his business. You'd know a lot more about your business, wouldn't you? We wouldn't have to make assumptions. Do we know, however, that roughly 80 is the right number? That part we do know. Why? Because that's the comparative with the industry, and that's the median. His comment to me is, you know, this is really tough. You can't compare me with the good guys. I'm in a tough market. I mean, it's tough. My response is likely to be what? We're not comparing you with the good guys. We're comparing you with the mediocre guys. And you still are looking bad. Apparently, you failed to keep the low standards you set for yourself. Now, I asked you to put yourself in two minds in this case study. If we're his banker, should we expect this? Banks loan money, right? They loan money. That's what they do. Businesses borrow money. We provide capital. If I'm your banker, we provide capital. What do you provide? Management, efficiency. But rather than that being a milquetoast term, we can actually now what? Measure it. We can measure this and identify exactly where the leak is occurring, and now we need a what from him? A commitment, a plan to fix it. I don't expect you to go from being a poor performer to a top performer, but I would expect us to work up over a period of 2 or 3 years. Is this doable? We can train ourselves to manage our businesses more efficiently. Just like the difference between somebody who is a recreational athlete and a professional athlete. They've trained to perform at what level? A higher level. It's one thing to hit a softball that comes in on an arc. It's another to hit a much smaller hard ball that comes in at 101 miles an hour. Can you train yourself to do that? Absolutely. Absolutely. Teams, and what they do is they just simply practice at a higher level. If you step into a batting cage and set the pitch speed at 60 miles an hour, when you get in against a 95 mile an hour pitcher, it's going to look what? You won't see it. On the other hand, if you set the machine at 110 miles an hour and do it over and over again, all of a sudden when you step up against somebody who's throwing 95, it's going to be what? It's going to look slower. We can train ourselves, and there's a number of teams that perform at a higher level. One in particular I can think of is a couple of years ago, the University of Michigan women's softball team won the national championship, and it was the first time ever that a team from east of the Mississippi and hardly outside the Pac-10 won the national championship, and that's exactly what they did. They throw about 70, 72 miles an hour in the NCAA. And so they set their pitching machine at 75 miles an hour and moved it from 41 feet or 42 feet down to 39 feet. That difference, when they got in against some of the best pitchers around, that difference, it made the ball look what? Bigger. When it slows down, it looks bigger. And when it's bigger, it's easier to what? Hit. We can train ourselves to perform at a higher level if we choose to. We just have to set the bar higher. And by putting in the right yardsticks is effectively doing what? Setting the bar. And so far all we've done is we've set the bar. We've identified where to set the bar now in terms of gross margin. When we get back together, what we'll do is take another look at this in another part of our roadmap, that part we call low cash. We'll take a trip through the low cash symptom and see where and how much might be hidden there.